0% chance of a U.S. recession in 2025.
Really?
That's what Apollo's chief economist, Torsten Sløk, says.
Okay.
In a recent note, he laid out 12 key risks for the global markets.
Mm-hmm. Interesting.
And some of them are pretty surprising.
That.
So this is interesting because considering the year we just had, the U.S. economy really defied expectations.
Yeah.
I mean, strong growth and job creation.
Yeah. It's really remarkable, isn't it?
Yeah, most people were bracing for a slowdown.
Right.
And it didn't materialize.
Go.
So instead of battening down the hatches for a recession, investors are looking at a whole different playing field.
Yeah, it really is a fascinating landscape.
Yeah.
Full of unexpected turns.
And Slick's note is like a guide to this uncharted territory.
It is.
So we're going to break it all down for you today.
Looking forward to it.
So let's start with what Slick considers the two most probable risks,
Okay.
both clocking in at a 90% likelihood.
No.
First up, tariffs.
Oh.
Remember all those campaign promises from Trump?
I do.
Well, Slick seems to think they're about to become a reality. And those threats have only escalated since the election.
That's true.
It's not just talk anymore.
Right.
He's even targeting traditional allies like Canada and Mexico.
It's getting serious.
And this is where it gets really interesting.
Okay.
Slick believes these tariffs could have a ripple effect,
Uh-huh.
far beyond just increasing costs.
I see.
So, for example, think about the impact on specific industries.
Okay, yeah.
American companies that rely on imported goods
Yeah.
could become less competitive,
Yeah, definitely.
leading to job losses or even factory closures.
Yeah, that's possible.
And on the flip side,
Mm-hmm.
those higher prices for consumers could fuel inflation.
Right.
So adding another layer of complexity to the economic picture,
But
it's like a chain reaction.
Yeah, exactly.
And Slick's second 90% probability risk hits closer to home,
Okay.
focusing on Nvidia,
Nvidia.
the AI chip powerhouse that's become the world's second largest company. And Slick's view is that there's a lot of hype around Nvidia, maybe too much.
Okay.
He thinks they might fall short of investor expectations,
I see.
which could have a significant impact on the markets.
For sure.
Remember what happened back in Q3 2024?
Oh, yeah.
They beat earnings estimates,
Yeah.
but they still missed some of Wall Street's more ambitious predictions.
Right.
And their stock took a 10% hit as a result.
Right.
So that was just a taste of what could happen if they disappoint on a larger scale.
That's a good point.
It could shake investor confidence, not just in Nvidia, but in the entire tech sector.
Yeah, they could.
So we've got these two major risks,
Wow.
tariffs and Nvidia's performance,
Okay.
that could really throw a wrench in the works.
Right.
But Slick also outlines some upside risks that we need to consider.
Okay, like what?
So these include the possibility of the U.S. economy accelerating even further,
Okay.
investor sentiment remaining bullish,
Right.
and a surge in mergers and IPOs.
Yeah.
And he assigns these a likelihood of 75 to 85%,
Wow. That's nothing to sneeze at.
which is nothing to sneeze at.
Yeah.
So while a recession might be off the table,
Well,
it's not all smooth sailing either.
right.
We've got this potent mix of potential upswings
Okay.
and pitfalls to navigate.
Yeah, I think that's what makes this so intriguing.
Yeah.
Like, how will these forces interact?
Exactly.
Could a booming economy actually be a double-edged sword?
Exactly.
That's interesting to think about.
A surge in economic activity sounds great on the surface,
Yeah.
but if it leads to a sudden spike in inflation,
Mm-hmm.
that could force the Fed to raise interest rates.
Oh, okay.
And that's a whole other can of worms.
It is.
Yeah, we've become so accustomed to low interest rates that a sudden shift could send shockwaves through the markets.
Yeah, for sure.
And it's a factor that could significantly influence both investor behavior and business decisions.
Absolutely.
So even with the potential for continued growth, there are some serious challenges on the horizon.
Yeah, what's fascinating to me is that this isn't just about the U.S.
Right.
These risks have global implications.
Yeah,
Think about how interconnected the world economy is.
exactly.
A policy shift in one country can trigger a cascade of effects around the globe.
Okay, let's shift gears for a moment and talk about the term animal spirits.
Animal spirits.
What's that? That Sløk mentions in his note.
Okay.
So it's not referring to actual animals, of course.
Okay, good.
It's a term economists use to describe the emotional factors that drive investor behavior.
I see.
So think of it as the mood of the market.
Okay.
If investors are feeling optimistic and confident,
Yeah.
they're more likely to take risks,
Uh-huh.
invest in new ventures, and drive market growth.
Right.
But if those animal spirits turn sour,
Yeah.
we could see a pullback, a flight to safety, and a slowdown in investment.
I see. Yeah, that makes sense.
And this is where Slick's predictions about tariffs and Nvidia come into play.
These factors could have a significant impact on investor confidence,
Okay.
either boosting it or undermining it.
Yeah, for sure.
It's a delicate balance.
It is.
And that brings us to Sluk's biggest downside risk.
Okay. What is it?
A scenario he gives a 40% probability to.
All right.
He believes there's a chance we could see a rebound in inflation in 2025,
Okay.
which would force the Fed to hit the brakes and raise interest rates.
Oh, wow.
And that runs completely counter to the current market expectation of 2 rate cuts in 2025.
It does, yeah.
So if this scenario plays out, it would be a major surprise,
Yeah, to say the least.
to say the least.
Yeah.
Yeah, and Slick isn't just throwing this out there.
Okay.
He paints a very specific picture.
Right.
He believes the inflation surge could hit in Q1,
Okay.
driven by a combination of factors.
Like what?
A strong economy, yes, but also the impact of tariffs,
Okay.
immigration restrictions,
Yeah.
and even seasonal factors.
Oh, wow. The seasonal element is particularly interesting to me.
Yeah, it highlights how seemingly predictable events, like the typical price fluctuations we see at certain times of the year,
Yeah.
could exacerbate an already tense situation.
So you've got this perfect storm brewing,
Yeah.
and Slick believes it could lead to the Fed raising rates and the 10-year U.S. Treasury yield jumping above 5% by mid-year.
Wow, that's a level we haven't seen in quite some time.
Yeah, and it would have significant repercussions, not just for the U.S. economy, but for global markets as well.
For sure.
Now, a 5% yield on the 10-year Treasury might sound abstract,
Uh-huh.
but it has very real consequences for everyday investors.
Right.
It can affect everything from mortgage rates to the cost of borrowing for businesses.
Yeah, and it can also shift the dynamics of the stock market,
Right.
making some investments more attractive and others less so.
Right. It's all interconnected.
It is.
And this is where it gets really crucial for you, the listener,
Okay.
to understand the potential ripple effects of these economic shifts, because they can have a direct impact on your investment portfolio,
Uh-huh.
your business decisions, even your personal finances.
Absolutely. That's why we're diving deep into these risks today.
Yeah.
It's about providing you with the knowledge and context you need to make informed decisions, regardless of what the future holds.
Exactly.
Uh,
Yeah, I think that's a great point to move on to part 2.
Sounds good to me.
So we've gone from worrying about a recession to potentially facing its opposite,
Yeah.
an economy that's running so hot it could trigger a chain reaction of consequences.
It's a fascinating paradox, isn't it?
Yeah.
And it challenges our traditional understanding of economic cycles.
Yeah.
We're accustomed to the ebb and flow of boom and bust.
Right.
But what if the boom itself becomes the source of instability?
Yeah, it's a mind-bending concept.
It is.
But Slick isn't just throwing out these predictions, he's
Yeah.
backing them up with specific scenarios.
Uh-huh.
And it's these details that I think are really valuable for our listeners today.
Yeah, I agree.
It's not enough to simply know what might happen.
Right.
We need to understand why
Yeah.
and explore the potential domino effects.
Yeah, that's where the real insights lie.
Okay, so let's unpack Slick's inflation rebound scenario a bit further.
Yeah.
He sees this potential surge hitting in Q1 2025.
Right.
And as we touched on earlier, he points to several drivers.
Yeah.
The robust economy is one, of course.
Uh-huh.
Then there's the potential impact of tariffs,
Okay.
the effects of immigration restrictions,
Right.
and the often overlooked seasonal factors.
Yeah, the seasonal element is particularly intriguing to me.
Yeah.
It suggests that even those predictable events, like the routine price fluctuations we see at certain times of the year,
Right.
could amplify this situation.
Yeah, so it's not just one massive shock then,
Right.
but a confluence of factors that
Yeah.
could push inflation over the edge.
And if that happens,
Yeah.
Fed is in a difficult position.
Right.
They have a mandate to maintain price stability. So their likely response would be to raise interest rates.
Which, as we discussed, could have a ripple effect throughout the economy.
Yeah.
Businesses might become hesitant to invest. Consumers might tighten their belts.
Right.
And the stock market could experience heightened volatility.
It's a chain reaction that investors need to be prepared for.
But here's the crucial point.
Yeah.
Slick assigns this scenario a 40% probability.
Okay.
So it's significant, but it also means there's a 60% chance it doesn't happen.
Exactly. And that's where things get really tricky.
Yeah.
Investors are constantly weighing potential risks against potential rewards.
Right.
and they're often forced to make decisions based on incomplete information.
Yeah, it's like a high-stakes poker game, isn't it?
It is.
You're trying to read the other players,
Yeah,
anticipate their moves,
right.
but you can never be completely certain what cards they're holding.
And in this particular game, the stakes are your financial future.
So what does all this mean for our listeners? What should they be doing with this information?
First and foremost, it's a reminder that the economic landscape is in constant flux.
Okay.
What seemed like a sure bet yesterday might be a completely different story tomorrow.
So adaptability is key then.
Absolutely.
Okay.
But it's not just about reacting to change.
Right.
It's about anticipating it.
Okay.
Slök's note provides a framework for understanding the major forces at play.
Mm-hmm.
But it's up to each individual to do their own research and stay informed.
So going beyond just reading the headlines,
Yeah.
digging into the data and forming your own conclusions.
Exactly. Don't blindly follow the crowd or rely on conventional wisdom.
Okay.
The most successful investors are the ones who can think independently
Uh-huh.
and make informed decisions based on their own analysis.
Let's bring this back to Slök's predictions.
Okay.
We've talked about the potential impact of tariffs on specific industries
Yeah.
and the ripple effects of Nvidia's performance on the tech sector.
Mm-hmm.
But what about those upside risks he outlined? The continued acceleration of the U.S. economy,
Mm-hmm.
persistent bullish sentiment,
Okay.
and a surge in mergers and IPOs.
Yeah, these are all factors that could significantly shape the market landscape.
Yeah.
A continued economic upswing, for example,
Uh-huh.
could lead to increased consumer spending
Okay.
and business investment,
Right.
which could fuel further growth.
But as we discussed, there's also the potential for that growth to become a problem
Right.
if it triggers a spike in inflation.
Yeah, it's a tightrope walk.
It is.
And that's where understanding the historical relationship between economic growth,
Uh-huh.
inflation, and interest rates becomes crucial.
Okay.
It's not a simple linear relationship.
Right.
There are tipping points and feedback loops
Yeah.
that can create unexpected outcomes.
Can you elaborate on that a bit?
Sure.
I think some of our listeners might benefit from a little more context here.
Of course, one of the classic examples is the period of stagflation in the 1970s. The U.S. economy experienced high inflation and high unemployment simultaneously.
Yeah, that's a scenario most of us have only read about in textbooks.
Right.
But it highlights how interconnected these economic forces are
It does.
and how unexpected outcomes can arise.
Exactly, and that's why it's so important to consider multiple perspectives,
Okay.
to challenge assumptions,
Yeah.
and to be prepared for surprises.
So what can our listeners do to better anticipate those potential surprises? Slök focuses on Q1 2025 as a potential turning point.
Yeah.
What indicators should they be watching right now?
There are several key data points to keep an eye on.
Like what?
Inflation readings, of course, are critical.
Okay.
Watch for any signs of an upward trend,
Uh-huh.
especially in those sectors that Slök identifies as potential drivers.
Mm-hmm.
Things like energy prices,
Okay.
commodity prices,
Yeah.
and housing costs.
Okay, so inflation data is a big one.
It is. Keep an eye on consumer confidence surveys. They can give you a sense of how optimistic people are feeling about the economy,
Yeah.
which can translate into spending patterns.
And what about the political landscape?
Oh, yeah.
We've talked about the potential impact of tariffs.
Right.
Are there any other policy decisions or political developments that could influence the economic outlook?
Absolutely. The upcoming midterm elections could have a significant impact on the direction of economic policy.
Okay.
Keep an eye on the candidates' platforms,
Yeah.
their stances on issues like trade and taxation,
Yeah.
and the potential shifts in power that could result from the election.
It sounds like there's a lot to watch,
There is.
but it also sounds like there's a lot of opportunity.
Yes.
If you're informed, if you're
Mhm.
paying attention, and if you're thinking critically,
Right.
you can position yourself to navigate these potential challenges
Yeah.
and capitalize on the potential upswings.
That's precisely the point.
Okay.
It's not about predicting the future with certainty, but about being prepared for a range of possibilities
Mm-hmm.
and having the flexibility to adapt as the situation evolves.
So we've covered a lot of ground today.
We have.
We've talked about Slök's predictions,
Yeah.
the potential risks and rewards facing investors,
Mm-hmm.
and the importance of staying informed and adaptable.
Right.
But I want to leave our listeners with a final thought.
Okay.
It's something that Sløk touches on in his note, and I think it's worth emphasizing.
Okay, I'm intrigued.
He talks about the importance of considering second-order effects.
Ah, yes, the consequences of consequences.
Exactly. It's not enough to just think about the immediate impact of a particular event or policy change.
Okay.
We need to think about the ripple effects, the unintended consequences, the things that might happen down the line as a result of that initial action.
It's like a game of chess, isn't it?
It is.
You have to think several moves ahead.
Yeah.
Anticipating how your opponent might react to your play.
Exactly. And in this case, the opponent is the complex and ever-changing global economy.
So as you're evaluating these risks and opportunities, as you're making your investment decisions, and as you're planning for your financial future, don't just focus on the immediate impact.
Okay.
Think about the second-order effects.
Right.
The unintended consequences. The things that might not be immediately apparent.
Okay.
That's where the real insights lie.
That's a great point to end on.
It is.
We've covered a lot of ground today, and I hope our listeners are feeling empowered to dive deeper into these topics and make informed decisions. But we're not quite done yet.
Okay.
We have one more segment to go.
Okay.
And I think it's going to tie everything together nicely.
I'm looking forward to it.
We've explored a lot of potential scenarios today.
We have?
Some positive, some not so much.
Yeah.
But the one thing that's clear is that we're not headed for a recession in 2025.
Right, at least according to Torsten Sløk.
At least according to Torsten Sløk, yeah.
Yeah.
And in its place, a fascinating mix of high probability risks.
It is fascinating.
That investors need to be aware of.
For sure.
So we've got tariffs potentially shaking up global trade, Nvidia's performance holding the potential to make or break market sentiment, and the possibility of an economic boom that could either propel us forward or send inflation spiraling.
Yeah, it's a lot to think about.
It's enough to make your head spin.
Yeah.
But I think the key takeaway for our listeners today is that vigilance is key.
I agree.
We can't afford to be complacent, even with a strong economy.
Right.
This isn't a time to sit back and relax.
Nope.
It's a time to be informed, engaged, and ready to adapt.
Absolutely. And that brings us to our final thought for you today.
Okay.
Sløk predicts that inflation could accelerate in Q1 2025.
Right.
So what indicators should you, the listener, be watching right now to anticipate potential shifts in the market?
Yeah, what are the early warning signs that things might be changing course?
Well, that's the million-dollar question.
Yeah.
And while we can't predict the future with absolute certainty, there are some key data points and trends that can provide valuable insights.
Okay, so walk us through it.
Okay.
What should our listeners be paying attention to?
Well, as we mentioned earlier, inflation readings are critical.
Okay.
But don't just look at the overall inflation rate.
Right.
Dig deeper into the specific components that drive it.
Okay, so looking at things like energy prices.
Exactly.
Food costs.
Yeah.
Housing expenses.
Yeah.
The things that make up the consumer price index.
Exactly.
Okay.
Watch for any signs of sustained upward pressure in these areas.
Okay.
If those core components start to heat up, it could be an early indication that broader inflationary pressures are building.
Got it. So we're watching inflation data like hawks.
Exactly.
What else should be on our radar?
Keep an eye on commodity prices.
Commodity prices. Okay.
Things like oil, copper, and lumber are often leading indicators of inflation.
Okay.
If their prices start to climb, it can ripple through the economy, pushing up costs for businesses and consumers alike.
Right. Those commodity prices can have a cascading effect.
They can.
Yeah.
And don't forget about the labor market.
Okay.
Wage growth is another important indicator to watch.
Okay.
If wages start to rise rapidly, it can put upward pressure on prices as businesses pass those increased costs on to consumers.
So we're watching inflation, commodity prices, and wage growth. Anything else?
Pay attention to what the Federal Reserve is saying and doing.
Okay.
Their monetary policy decisions have a huge impact on interest rates.
Yeah.
Which in turn affect everything from mortgage rates to business lines.
So reading those Fed statements, listening to those press conferences, trying to decipher what their next move might be.
Exactly.
Okay.
They provide a lot of clues about their assessment of the economy and their plans for the future. And remember, Sløk's entire scenario hinges on the Fed raising interest rates in response to an inflation surge.
Right.
So understanding their thinking is crucial.
Yeah, this is a lot to take in.
It is.
But I think the main message here is that knowledge is power.
I completely agree.
Yeah. The more informed you are,
Yeah.
the better equipped you'll be to navigate whatever comes next.
And don't be afraid to challenge assumptions,
Yeah.
to question conventional wisdom, and to think for yourself.
That's what the deep dive is all about.
It is.
We're here to provide you with the tools and insights you need to make sense of a complex world.
So keep learning, keep exploring, and keep diving deep.
Yeah.
And most importantly, don't be afraid to ask questions.
Right.
The more you question, the more you learn.
And on that note, we'll wrap up today's episode.
Sounds good.
Thank you for joining us on this deep dive.
It was a pleasure.
We'll be back soon with another insightful exploration of the forces shaping our world.